If oil is the fuse, inflation is the bomb, and Jamie Dimon just warned it could be the skunk at the party no one wants to smell. After US and Israeli strikes on Iran over the weekend, and reports that Supreme Leader Ayatollah Ali Khamenei was killed, crude spiked immediately on supply fears. At the same time, the VIX jumped to its highest level of the year. The reaction wasn't subtle. Traders instantly started repricing the risk of prolonged disruption, especially if tanker traffic tightens or the conflict stretches into what President Trump warned could be 4 weeks or so. Here's the tension. Headline CPI cooled to about 2.4% in January, the softest since last May, giving the Fed some breathing room. But wholesale inflation is running closer to 2.9%, well above the Fed's 2% target. That's the pressure point. Energy shocks bleed into transport, manufacturing, and consumer expectations. Dimon's point wasn't panic, it was duration. A short conflict nudges gas prices. A long one risks re-anchoring inflation higher. He also flagged second-order risks, cyberattacks, terrorism, banks as targets. That's not macro theory, that's operational risk. And when the CEO of the largest US bank starts talking about systemic resilience, desks listen. He even addressed the president's $5 billion debanking lawsuit, calling it meritless while defending regulatory necessity. Another reminder politics and capital markets are now inseparable. Then he zoomed out. On AI, he acknowledged displacement, but framed it as a productivity revolution. Shorter work weeks, longer lifespans, medical breakthroughs, optimism, but conditional. So the takeaway isn't just geopolitics. It's this: if oil stays elevated, inflation doesn't glide lower, it lingers, and lingering inflation changes everything about rates, multiples, and risk appetite.